As the financial system rebounded after the Great Recession, inflation remained low. Inflation has never risen above 2% for numerous years. Inflation has made a comeback in recent months. Although President Biden has described the current situation as transitory, many people believe that inflation is here to stay. Welcome to Wise Thinking channel. Before we get going, make sure to like this video and subscribe for more videos. Getting to know inflation. Inflation is defined as a general increase in prices in a given economy over a given time period. The Federal Reserve usually aims for a low and constant rate of inflation of around 2%, which indicates that the economy is growing. However, inflation has risen and fallen throughout history. Prices rose 10% to 15% in several years, during the 1970s and 1980s. Inflation has slowed since then. Inflation rates ranged between 2% and 5% in the 2000s, whereas they stabilized between 0% and 2% in the 2010s. In other words, relative to other periods in history, prices have remained remarkably constant in recent years. Inflation, on the other hand, has recently resurfaced as a topic of discussion. Inflation was 5.4% in the 12 months ending in July 2021, one of the highest rates in several years. Inflationary types. Inflation can be classified into three categories. Inflation caused by demand. When demand exceeds production capacity, demand pull inflation occurs. In other words, there is a greater demand for commodities than present supply can meet. As a result, the cost of living rises. Inflationary cost push. When manufacturing costs rise, corporations find it more expensive to create the same commodities. This is known as cost push inflation. As a result of the rising cost of inputs, market prices rise. Inflation built in. Workers want higher wages to offset growing living costs, resulting in built-in inflation. This form of inflation can have a feedback effect, causing businesses to boost prices to keep up with rising labor costs. Why is inflation taken into account? Inflation has a variety of unsettling impacts, the most obvious of which is that it erodes your purchasing power over time. As inflation sets in, a dollar will purchase less goods and services than it did previously. Because interest rates have been unusually low over the last decade, long-term investors and retirees alike have become increasingly complacent about the possibility of inflation. In the future, inflation must be recognized as a significant threat to a comfortable retirement if it is not properly accounted for. Inflation adds to the economy's uncertainty. Inflationary pressures compel the Federal Reserve Board to act, which is expected to hike interest rates in response. In the short term, the Fed's actions may increase stock market volatility, and higher rates may cause bond funds to lose value. At the very least, the possibility of inflation and increasing uncertainty is an additional incentive to review your investment strategy to ensure that your assets are properly diversified. A well-diversified portfolio that isn't overly reliant on any single asset class is a good place to start when it comes to protecting your money from inflation. Inflation's benefits and drawbacks. Pros: inflation that is low and consistent might be a sign of a flourishing economy. It is advantageous to those who have fixed-rate debt, such as mortgages. It encourages people to buy now rather than later. Cons: inflation diminishes purchasing power by reducing the amount of products that each dollar can buy. Consumers are hurting as a result of higher prices across the economy. It is detrimental to pensioners on fixed incomes. It causes the Federal Reserve to take action. How to make money off inflation. Here are 5 inflation protection strategies to help you stay afloat when costs rise. 1. The real estate market. During periods of inflation, single-family houses funded with low interest, fixed-rate mortgages tend to do well. As inflation rises, the value of your home is likely to rise, while the monthly service cost of your mortgage remains same. This is at the heart of accumulating home equity, which can significantly boost your net worth. You may protect yourself from rising rents by acquiring real estate. Rents, like any other consumable commodity, tend to grow as inflation rises. Mortgages have a benefit over rental agreements when inflation is high, despite the fact that they are less flexible. 2. Stocks with a high value. According to some data, value equities outperform growth companies during inflationary periods. Companies with good earnings relative to their present share price are considered value stocks. They are also known for having strong cash flows, which investors prize when stock prices are rising. Growth stocks, on the other hand, are more susceptible to interest rate fluctuations, which is a usual monetary policy reaction to inflation. Growth stocks have had a great run in the last decade, while inflation has been glaringly absent. Value stocks, on the other hand, have recently made a resurgence. Their success is expected to continue in the current context. 3. Goods and services. Gold and other precious metals, as well as raw materials and other natural resources, are examples of commodities. Simply said, as the economy's demand grows, prices rise, and the cost of production to supply that demand often climbs in lockstep. During times of uncertainty, commodities are commonly viewed as safe haven assets. Commodities, unlike stocks and bonds, do not pay dividends or represent any underlying business. They are also uncorrelated and move in opposite directions. 4. TIPS. Treasury Inflation Protected Securities, or TIPS, are marketable U.S. Treasury securities designed to protect against the erosion of buying power. TIPS benefit from periodic inflation adjustments, which are not available with traditional fixed-rate bonds. TIPS should be considered as part of a lower-risk portfolio component for investors seeking capital preservation and buying power stability. TIPS holders can rest assured that their principal will be returned, because TIPS are backed by the United States government's full faith and credit. I-bonds are the fifth type of bond. Savings bonds in the United States become attractive investments during inflationary periods. I-bonds guarantee to keep up with inflation, despite the fact that you can only buy $10,000 per year, and they are considered non-marketable assets. They, like TIPS, provide a nearly guaranteed return of capital. Investing in I-bonds will not yield high profits, but it will protect purchasing power for a portion of your portfolio. Given that many investments, such as cash and long-term bonds, are expected to lose real value during inflationary periods, it is sense to consider alternatives to equities that can keep up. Inflation is a blessing in disguise. Consider inflation as an opportunity to reassess your entire portfolio, as it occurs with or without our permission. Even though inflation had recently risen, interest rates remained near record lows as of August 2021. One of the most effective strategies to battle inflation is to make sure you're properly diversified and fully invested on a regular basis. Long-term, money invested in stocks tends to beat inflation, whereas real estate, commodities, TIPS, and I-bonds can only provide more diversification. If interest rates begin to climb, cash on the sidelines would lose value, while long-term bonds will be impacted. In general, inflationary periods, whether temporary or permanent, provide an opportunity to review your financial condition and make adjustments for the future.